Hello and welcome to Chapter 2. In Chapter 2, we're going to learn all about job order costing, which really is important for businesses because it's going to help us determine how to calculate our unit product costs. Why is this important? Well, because if you don't know how much your product costs you to make, then you're not going to be able to make good business decisions about pricing and whether or not you'll be able to make profit by selling your products. Job order costing systems are used when we have many different products that are produced each period. The products are manufactured to order, meaning based on customers calling in specific orders, and then the unique nature of each order requires tracing or allocating costs to each job. In other words, each order is unique or different, and that means that we can't just apply the same cost to every single job because each and every job is unique and incurs a different level of costs. What are some type of companies where job order costing would be used? Well, Boeing would be an example. They make aircrafts, and each plane is a little different and very expensive. Large-scale construction would be another example. Movie production, all movies are different. They're going to incur different levels of costs. Basically, any type of company where they're producing a lot of different types of products, and the products can be customized. Where you're not going to see job order costing is when we're doing mass production. So we're making cornflakes, we're making ketchup, we're making flour. None of that stuff is going to need job order costing because it's all mass produced. Every product is effectively the same with minor variations. So what we would use for that is process costing. But because process costing really only helps with mass production, and most of you will not have a future job in a plant that mass produces items, we skip that chapter. The reason we focus on job order costing and related to manufacturing is that it's very easy to follow the costs with tangible items like completed goods. However, job order costing is also useful for service industries where I would imagine most of you will end up. So this will be beneficial to you beyond the scope of this course. It'll be beneficial to you in your futures, no matter the major you decide to pursue. So you may remember, hopefully, from Chapter 1 that we have two types of direct cost, and that's direct materials and direct labor. And because they're direct costs, it means we can trace them directly to individual jobs easily and effectively. So that's what this slide is showing you. It's showing you the direct materials can be traced or allocated to each job individually, job 1 to 3, and then direct labor costs can also be allocated to each job individually. We're going to be able to track the actual amount of direct materials and direct labor that each job incurs. So therefore, we can trace those costs to the job. Overhead, on the other hand, you may remember we learned is an indirect cost. This is all of the factory or production related costs that are not considered direct materials and direct labor. This would be things like the factory supervisors, the factory maintenance personnel, the production utilities, the property taxes for the factory, etc. So these costs are indirect. They can't be traced directly to a job. For instance, the property taxes on the plant are not incurred because of any one job. They're incurred because we have the plant, and inside the plant or factory, we make all of our individual jobs. So we need to come up with some methodology in order to allocate our manufacturing overhead costs to each individual job, which is going to require some level of estimation. Because we aren't able to directly trace the amounts to the jobs, we're going to have to come up with a way to allocate those amounts. So how do companies track the jobs that they incur for a particular project or job? Well, they use what's called a job cost sheet. And this job cost sheet may look intimidating, but it really isn't. All it really is going to do is summarize the costs that are incurred for a particular job or product. And those three fundamental costs are direct materials, direct labor, and overhead. So the whole goal of a job cost sheet is to track the costs that are incurred in order to make the final product or the final job. So you could see this example, we're making wooden cargo crates. So we're going to track all the materials and labor associated with making those wooden cargo crates, and then we're going to allocate the overhead costs to the job so we can get a full cost of making the product. We can't ignore overhead. Even though the job doesn't create the overhead on its own, those overhead costs need to get allocated to individual jobs in order to do effective pricing. If we ignore the overhead altogether, we may underprice our jobs, and then in the end, the company is going to end up losing money because they still have to pay all of those various overhead costs. And if their jobs don't make enough profit to cover those costs, they're going to find themselves in a position where they might go out of business. So it's extremely important that we include all three elements of product cost: direct materials, direct labor, and overhead. So let's start with direct materials. Direct materials are the items that actually go into making the product, and because we're making cargo crates, we're using wood. So you could see that in the materials requisition form, we have various feet of 2x4s and 1x6s that are going to be used to create this job. So this product materials requisition form is just a list of materials that are being used to create the job. So you could see we've incurred $116 in materials cost in order to build these cargo crates. That $116 would be our direct material cost that shows up on our job cost sheet. The labor would relate to the people that are putting that wood together and making the wood into crates. So we can see here an employee time ticket for an employee named I Am Skilled, so very creative. And they have their time card, and it shows that they worked 8 hours. They make $15 an hour for a total of $120, and they were completing job A143, which is the job that we're interested in. So those labor costs are going to get directly traced to our job and included in the job cost sheet. So the labor hours that are used for the job get directly traced and included in the job cost sheet. That part is relatively easy to do because direct materials and direct labor can be directly traced to our jobs. Now we're going to have to figure out the best way to allocate the overhead cost because we can't directly determine the exact amount incurred by each individual job. To do that, we're going to calculate what's called a predetermined overhead rate. In order to allocate overhead, we need some type of allocation base, meaning a driver that we can use to allocate the overhead costs to each individual job. So a lot of times companies will use allocation bases such as direct labor hours, direct labor dollars, or machine hours in order to assign the overhead to the jobs. It's impossible or difficult to trace the actual overhead costs to particular jobs, which is why we need to go through this process. And manufacturing overhead includes all sorts of different items, ranging from the grease used in machines to the production manager's salary. And some of the costs are fixed and some of them are variable. So it would be very difficult to directly trace the cost. And frankly, even allocating the cost using a driver is not perfect because not all of the costs are going to be driven by one driver. But for simplistic purposes, most companies do use one predetermined overhead rate for the whole company, with the idea being that it's good enough. It's providing good enough cost information. Now, in financial accounting, good enough wouldn't be good enough because we're focusing on having reliable data. In managerial accounting, we want relevant data. So we sacrifice a little bit of that reliability in order to get the information quickly and when we need it. So how do we get our predetermined overhead rate, commonly called the POHR? Well, we're going to take our estimated overhead over our estimated driver. For problems in this class, the hard part is going to be done for you. The estimated overhead is going to be given and the estimated driver is going to be given. All you're going to have to do is the math. In the real world, estimating that future overhead cost and figuring out the best driver to use can be a challenge. But luckily, in our class, we're going to already have that done for us. We're just going to actually go through the calculations. But we would really have to use a lot of different personnel at the firm in order to figure this out, like the factory, production supervisor, different accountants, and managers would all have to get together to come up with these estimates. The key to remember here when getting a predetermined overhead rate, especially when you're doing problems on quizzes and exams, is to remember the predetermined overhead rate is based on estimates. The key way to remember that is the word pre means before. So we're getting the predetermined overhead rate before we actually know these finalized numbers. So the predetermined overhead rate is calculated at the beginning of the year based on the estimated amounts of overhead costs that we think we're going to incur in the upcoming period, and the estimated units of the allocation base, like direct labor hours or machine hours, we believe will incur in the upcoming period. So this is not going to be perfect, but it's going to give us something to use in order to allocate our overhead. You might say, well, why go through this effort? Why not just wait till the end so we can actually have the correct amounts? And again, it relates to the timeliness need in managerial accounting. We can't wait to the end of the year to figure out how much these jobs cost. Customers aren't going to wait forever to figure out what the price of the job is. And if we wait too long and we just give a price out without knowing the true job cost, we're going to find ourselves making very poor decisions, which might put the company in jeopardy of failing. So we need to do this at the beginning of the year so we can estimate job costs throughout the year. And then at the end, when we're off, we'll adjust for any deviation to make the final numbers accurate and correct. So the predetermined overhead rate is using estimated data, as I already mentioned, and that's because the actual overhead isn't known, and actual overhead can fluctuate seasonally, which would also create misleading decisions. Why would that be the case? Well, if in the summer all of a sudden you incur a higher level of, say, air conditioning costs, and then that would mean that if you didn't calculate a predetermined overhead rate and you allocated overhead monthly, let's say, then the summer months you'd end up allocating more costs to your jobs simply because you're using the air conditioning. Whereas in the winter months, assuming you're in a mild climate, you wouldn't incur the air conditioning costs and your heat costs would be relatively low, assuming you're not living up here with us in New England. And that would ultimately mean that jobs would simply be costing more different times of year, which really wouldn't be fair. Why should I pay more for something just because you made it in the summer versus the winter? So in order to keep our costs consistent throughout the year, we use a predetermined overhead rate that's determined at the beginning of every year. So how do we get the predetermined overhead rate? Well, it's going to go back to that formula we determined for mixed costs, because manufacturing overhead is a mixed cost. It includes both fixed and variable components. Remember, I don't like the formula given in the textbook. I prefer y equals f plus vx. So again, change that up down here as well. And the reason I like that is because the F is your fixed overhead cost and your V is your variable cost per unit. And the F and V remind me what they stand for. So because the overhead is based on fixed and variable costs, we can use this cost formula to predict what those costs would be.